Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe with Streamline Capital. Very excited for today's show. We've got the very famous Jay Scott along with us today. So, Jay, welcome to the show.
Wow, famous. I'll take that. I
Yeah.
thought that was just my mother who thought that, but I'll take it.
Well, you got all those books on the wall behind you, and I figured, gosh, if you've written a bunch of books, you got to be famous.
Well, hopefully the books are well known. I'm not sure I am, but I'll take it.
Yeah, so let's talk about you for a little bit. Tell us a little
Sure.
bit about yourself and start out by how you got into real estate.
Yeah. So I started out in the tech world.
Mhm.
So both my wife and I spent most of our careers in tech in Silicon Valley. We met in California back in the mid 2000s, and when we decided to get married in 2007, we realized that we just didn't have the work life balance we wanted. My wife was traveling several weeks a month. I was traveling a couple weeks a month for my job,
Yeah,
and we knew it just wasn't sustainable if we were going to have a family.
right.
So instead of one or the other quitting, we decided let's both quit our jobs. We'll figure out something else that will give us better work life balance and we'll go from there. And so, May of 2008, we left our jobs. We moved from California to the East Coast. We moved to Atlanta, Georgia. And while we were trying to figure out what it was that we were going to do next, we decided to flip a house just for fun. That one house turned into two, turned into five, turned into 50, turned into a couple hundred. And before we knew it, we were house flippers.
Awesome. So 2008, flipping a house, that sounds pretty brave. Talk about that for a little bit. What challenges did you have due to the market?
So I like to say that you can replace bravery with stupidity in many cases. And I think that's
I
what
wasn't going to say it, but
yeah, I can admit it. If we had known back then what we knew now, we
Mhm.
probably never would have started flipping. But the reality was that it was a great time for a number of reasons. It was challenging, but the reality is it's always challenging in real estate. There are going to be times that are buyers markets where it's easy to buy properties, but it's tough to sell. There's going to be times where sellers markets where it's hard to buy properties, but easy to sell. There's going to be times when it's easy to get financing, but hard to get equity. Times when it's easy to get equity, hard to get financing, et cetera, et cetera. And 2008 was just one of those situations which was very different than today, but no more or less challenging. So today it's really tough to find good deals, but if you can find one, it's easy to sell on the back end after you've renovated it.
Yeah.
Back then it was just the opposite. It was really easy to find great deals. In fact, we literally bought our first 100 houses off the MLS. They were foreclosures, so bank owned REOs. And we flipped them, and it was the back end piece that was difficult. It was hard to sell. But then you
Yeah.
had other things like financing was tough, lending was tight, and finding private investors was tough, but finding contractors was simple. I mean,
Yeah.
2008, all the bad contractors had gone out of business. All the good contractors were desperate for work. So you could get great contractors at great prices who were very loyal, who weren't jumping ship to go to a better project or a higher price project every couple months. And so, yeah, it's good and bad. And in retrospect, I'm glad we didn't know enough not to
Yeah.
jump in, and
Mhm.
things worked out.
Yeah, I bought my first in 2007. It was a long-term hold is what we were planning on it, but yeah, the timing wasn't awesome, but we did well, and started a lot of things. But what you were explaining reminds me of something I've heard a lot and I've said a lot. Easy to buy, hard to sell.
Yep.
Have you ever heard that before? When
Yeah.
things are really, really easy to buy, they're going to be hard to sell and vice versa.
Yeah, everybody always wants to complain it's not a good market because it's hard to do X or Y or Z. But the reality is there's no market where everything is easy. If there was ever a market where everything was easy, then there'd be so much competition that nothing would be easy. So the reality is there's always going to be something that's difficult, something that you have to get really, really good at. And if you're not really, really good at whatever that thing is or those things are, you're not going to be successful. And over time, it's transitioned. We needed to be really, really good at marketing and selling back in 2008, 9, 10, 11, 12. Now we need to be really, really good at buying and underwriting and making sure that we're analyzing deals correctly. And so that thing that you have to get good at is going to change. And the best investors are flexible. They're good at a lot of things. They have the ability to learn and to recognize when they don't know everything.
Yeah, I think it's just a different kind of hard. I mean, I got into multifamily about 7 years ago, and this is right before competition got really, really fierce. But I would say 2020, 2021, we were putting out. I mean, we were one of 10 offers, or sometimes one of 20 or one of 30 offers on everything we basically chased. So I'm definitely a different type of hard. Raising money was super easy at the time, but now it's opposite. Now you're looking at 10 deals and none of them have offers on them, and
Yep,
raising money is the difficult part. So I'm generalizing, but yeah, just it's a different kind of hard based on the market.
100%.
So you started doing a lot of flipping. What else have you done in kind of the real estate big blanket field?
Yeah, so starting in 2008, we did a lot of flips. We held a bunch of properties as rentals. We did some lending. We did some other, not so much esoteric, but probably these days considered esoteric strategies, things like short sales and lease options and things like that. Things you don't have to do today, again, because it's pretty easy to disperse the property on the back end. So we did that for about 10 years. And 2017, we had flipped 400 or 500 houses. And honestly, we were burned out. I was burned out. And I said to my wife, I don't want to do this anymore. I want to figure out something else. I thought about going back to the tech world. I was doing some advisory work for a few startup tech companies and thought about just continuing to do the advisory work. But what I realized is after I stopped flipping houses, I had all this cash that came back to me pretty much
Mhm.
all at once because we were funding a lot of our own deals.
Yeah.
And so I had a bunch of cash sitting in the bank and I had to figure out what to do with it. And what I wanted to do with it was the thing I knew best, which was real estate. But
Yeah.
I'm not a big fan of investing with other people. It's funny because I'm a syndicator now and I take money from other people, from passive investors, but I'm a control freak as well. And I don't like investing as an LP with operators. And
Yeah.
so what I said was I want to invest in real estate. I really like multifamily real estate from a risk adjusted return standpoint, but I don't just want to be a typical LP. So I reached out to my friend Ashley Wilson, who was doing multifamily syndication at the time. And I basically said, look, I'm trying to figure out what to do with this cash. I think I want to learn the business so I can kind of control my own destiny, but also invest my own capital, but not have to deal with the day-to-day stuff I hated about single family flipping. And she said, great, come work with me for a year. I'll teach you everything I know. It'll be like a good chance for us to leverage kind of your relationships and your money and your time and your knowledge and your systems and processes. And at the same time, you can leverage our knowledge in multifamily and the deals we're doing, et cetera, et cetera. And so I said, great, let's do it. So I committed to a year working with them. And at the end of that year, what I realized was Ashley and I had a tremendously complementary set of skills. There were
Yeah.
things that she was amazingly good at that I hated doing. There were things that I was, I think, amazingly good at that she hated doing. And between us, we basically had all of the components of a tremendous partnership that could do a lot of really successful deals. So 2020, we decided to partner up, and we've been partners at Bar Down Investments for the past 5 or 6 years.
Nice, nice, nice. So I love the idea, or I love the fact that you guys have kind of like this complementary skill set. I think that's important with lots of partnerships. Otherwise, things don't get done, is what I found out. But what types of things do you like to do versus, not like to do?
Yeah, and this is, I mean, just for anybody out there listening that's getting started, that's thinking about partnerships, one of the biggest mistakes I see new investors or new business people in general make is they go out and they try and find people exactly like themselves. They want somebody with the same background, with the same set of skills, the same set of weaknesses, because who do we like to hang out with? We like to hang out with people just like ourselves. And there's nothing wrong with that from a friendship standpoint, but from a business standpoint, 2 or 3 or 5 people together that all have the same skills and same weaknesses doesn't make for a good partnership because those weaknesses get amplified and there's only so much amplification you can do on your skill set. And so you're never fulfilling those things that need to be fulfilled. And so I'm a big fan of, if you're looking for a partner, go find somebody who's the exact opposite of you in terms of strengths and weaknesses and interests. For Ashley and myself, it's a pretty traditional syndication partnership. And you'll see this for a lot of syndication partnerships where one person is the operations person,
Yeah.
boots on the ground, asset management, dealing with property management, dealing with construction management, dealing with figuring out rents and supply and demand, absorption rates, basically can look at the property in the context of competition and comparables and basically manage the property from beginning to end. And then there's the person who's really good at the analytical piece and or the fundraising piece.
Yeah.
Basically, the person that's really good with capital stacks, understands the debt markets, understands how to raise equity, how to structure deals, how to underwrite the legal and compliance piece, because there's a lot of legal and compliance that goes into raising money. And so for us, I was that analytical underwriter, debt markets, equity raise, legal compliance person. Ashley's very much that boots on the ground, asset management, construction management, dealing with the property management company, can look at comparables and figure out rents and all of that sort of stuff.
Yeah, yeah, yeah. That does seem to be how a lot of people do split it up. I think there's definitely something to that. And I mean, something I've noticed about myself, this is where, when I'm looking at, hiring or partnering, I am not awesome at following up. There's a couple of tests that I've taken that kind of point out where your strengths are and where your weaknesses
Mhm.
are. And so one thing I do every time that I'm looking at, long-term partners or employees is I look at their follow-up. I give them the same test and see where they score on follow-ups.
Yep.
So it's something that I am notoriously bad at. So yeah, if for anybody listening, if I haven't responded to your email address, or your email, or text or whatever, yeah, it's because I'm bad at that. But yeah, it's nice. You have to fill in all of this total skill set you need to run things, and it's not never found in one just one person. So
Yeah. And the other thing that I found with good partnerships, there's always at least one person who thrives on chaos
mhm.
and one person who is tremendously organized and can deal with the details.
Yeah.
And very much we have the same thing in our partnership. Ashley thrives on chaos. I mean, she's dealing with putting out fires day in and day out. Me, I'm focused on systems, processes, organizing the business, making sure things run smoothly, making sure the T's are crossed and I's are dotted, and we're doing all the things we need to do on a daily basis. And so it's great because when something comes up, it's pretty easy to figure out if it's in her wheelhouse or mine. So we rarely are going to argue over whose task something is, or how we're going to solve it, because whose ever task it is, they're responsible for figuring it out.
Yeah, that's something that's also important in partnerships, clear lines. If you have clear lines, it's really easy to see who does it. Hey, we were on a call yesterday on one of our properties, and I won't say anything that identifies the property, but it's one of the cases in syndications where there's too many cooks in the kitchen. I'm sure you've
Yeah.
seen that before. And, somebody said, well, hey, so and so should do this. And I piped up, I'm like, well, we've already assigned that responsibility to somebody,
Yeah.
so why don't we give that responsibility to the person who's supposed to be doing it? And I think when you have things organized like that, and when you have, all the lines drawn, and especially if it's around your personality style, it makes everything a lot easier. So,
Yeah, I think people don't realize that a small business is, in a lot of ways, not much different than a big business. Certainly, everybody needs to be a little bit more flexible. But
yeah.
when you think about it, I come from the corporate world. I spent much of my career at Microsoft.
Mhm.
And you go into Microsoft and you're looking at a product being developed at Microsoft. There are engineers who are writing code all day. They're not sitting in on the meetings with the salespeople and the marketing people. There are people that are doing quality assurance, and they're not sitting in on meetings with the finance guys. And so everybody has a role, and what they do all day is they do their job because that's what they're really good at. That's what they're getting paid to do. And you could imagine if, like, the engineers at Microsoft decided to say, "Nope, we're going to take over marketing tomorrow."
Oh, gee.
Things wouldn't go well. But we do that in the startup world. We say, "Hey, everybody needs to do everything." And okay, well, Bob might be really good at marketing, but he's out today, so I'm going to take over marketing. No, don't do
Yeah.
that. Let the person that's good at the role, that's been assigned the role, do it, because there's a reason why they were assigned to the role.
Yeah. And the lanes are important, but going back to what you said earlier, if there's two people in a group, you have to assign it. But as you grow, you can be more focused, is what I found. The more people you add to the team, the more somebody can focus on just one aspect of what has to be done. That's something that we're trying to figure out right now, how to start scaling. Right now, there's three of us in our company,
Yep.
and who's the next person to add, and
Yep.
what we're looking for, and what exactly. Yeah, one thing I learned by mistake is I need to create the roles and tell people what they're doing, before I hire them. But I have hired somebody without, a clear job description. Didn't go well. So,
Yeah, yeah. And I think that's one of the things that a lot of us, hiring and managing is really tough,
mhm.
but it really can make the difference between a successful and an unsuccessful business, because it's really easy to think, okay, I'm going to find a super smart person. They're going to come in, they're going to figure out what to do, and they're going to hit the ground running. But the reality is, if there's somebody that's smart enough to jump into your business and just hit the ground running and do everything they need to do, they're probably competing with you. And so you need to take responsibility for, if you're going to bring somebody into the business, you need to set aside the time. You need to time block and say, I'm going to spend 30 hours a week training them for the first 2 months, and I'm going to spend 20 hours a week, and then I'm going to spend 10 hours a week. And if
Mhm.
you don't have the time to do that, because it's not just hiring, it's really making sure they're successful. And the other thing is, you need to teach people culture. Businesses are successful when the people you hire aren't just really smart and really good at what they do, but they fit in with the culture. And a lot of times, fitting in with culture means learning the culture by working with those around us.
Yeah. I've had a couple people, and I've hired probably 6 different people over the last several years. And the ones that didn't fit, it was rarely a skill set thing. It
Yeah,
was most often a culture thing. You know,
100%.
and everybody has their own culture, and even if you don't have a culture, you still have a culture, right? But I think for the most part, it's been the culture fits that have ended up parting ways in one way or another. But yeah, important, good stuff. The other thing you said is, if somebody comes with all the skill sets, if you're a new business owner like me, you can't afford them. is,
Right.
is the other part. Yeah, they're either competing with you or you can't afford them. But
Yep.
maybe you ought to just figure out a way to afford them.
Well, that's the cool thing. I mean, there's lots of ways of bringing people on board. And depending on what you have abundance of, whether it's time or money or whatever it is, knowledge, you can figure out different ways to bring people on board. People can come on as partners. People can come on as employees. People can come on as commissioned. They can come on as interns. They can come on as part-time employees that you're sharing with other groups. There's lots of ways to bring people in. And we get into this idea of, okay, we have to have 2 partners, and then we have to have 7 employees, and then we have to have 3 no, let things be flexible and bring people in different roles in different ways, because you never know what might work. And so we've learned a lot over the years that things we try and do in-house, maybe it's better to bring in a third party consulting or vendor company to do things. Maybe it's better to bring in an intern or a commissioned person instead of hiring a full-time employee. Just be flexible.
Yeah. And I love what you're saying, because that's kind of what's happened in the last 2 years. At first we were trying to do our own marketing, and then we realized, okay, let's hire a marketing company, and then at one point, I was going to hire somebody to be the asset manager on our team, but we ended up, partnering with somebody who's, absolutely wonderful and has owned a property management company.
Yep.
And so she's our asset manager. She's not on payroll, but we worked it out. We figured out a solution. Here's how we're going to set this up. Here's how you're going to get compensated. Here's how everything else. And we do something similar with our construction management. One thing I do is I hire one general contractor for all the work, and I
Mhm.
let them do the management, because right now we're not big enough to bring that in-house yet. So
Yeah.
I love it. Yeah, flexibility, and just, be very, very solution oriented. I think that goes a long way. So let's start talking about, bar down a little bit. I mean, you talked a lot about all the flipping and starting and partnering with Ashley. By the way, I probably ought to bring her back on the podcast. It's been a couple of years since
She's great.
she's awesome. Yeah. Has a really, really good following too. So back to what I was saying, which I've almost forgotten. Let's talk about, how things have progressed for you after joining up with Ashley, and how things are going for you in the syndication world.
Yeah. So we have done 5 deals over the last 5 years. We don't do high volume. I mean, we both got into this business as a way to kind of deploy our own capital. So unless we find deals that we're comfortable putting in a good bit of our own money, we're not going to do the deal. And I think we're both pretty conservative. So we haven't done a lot of deals, but we've done 5 deals. We own about 1,100 units. We haven't done a big deal since 2022. Not
Mhm.
for lack of making offers and looking at deals, just it's been a tough market for a couple of years, and we just completed, or in the process of completing, our most recent raise for a deal we did find, and we're branching out into ground up construction, multifamily construction. So we'll be doing our first large multifamily construction project kicking off in the next couple months.
Nice. So why going from buying existing to development?
So part of it was opportunistic. So we have a good set of developer partners that we are comfortable and confident that can make a deal like that successful. And when you have the right team around you, it really opens up possibilities that otherwise wouldn't be there. So we've kind of kept our eyes open for a development opportunity for the last couple of years, simply because we knew we had the talent around us and partnerships around us that we could do that. But secondarily, just the direction the market's been heading. So what we're seeing is, from a supply perspective, in a lot of markets around the country, we're likely to see a drop off in supply over the next couple of years.
Yeah.
So a lot of apartments have come on the market the last couple of years. What we're seeing is there are very few new developments in the process of being started over the next year or two. And because these things take 2 to 3 years to deliver, that means in 2 to 3 years, we're likely to see a lot fewer apartment complexes coming online. And so I think there's going to be an opportunity in a couple of years, if we were to start today, which we are, in a couple of years when we're ready to deliver that product, I think we're going to find that there's not nearly enough supply and a good bit of demand that will absorb those
Nice.
units.
Yeah, and I'm looking very closely at those numbers as well, just taking a different approach. We're buying stuff now and trying to make sure we're holding through that period
Yeah,
because, yeah,
absolutely.
we're both expecting, I think, the same thing. We're both expecting, when supply dwindles, you're going to have higher occupancies and
Yep,
you're going to have higher rents and you're going to have higher
absolutely.
property values. And you're
Yeah.
just, sounds like you're just taking advantage of that in a slightly different way.
Absolutely. Yeah. And we're still looking at the repositioning, the value add deals. We're not changing strategy for the whole company. But again, this was an opportunistic play that kind of came across our desks about a year ago, and it ended up being a deal that was too good to pass up. So we are branching out.
Awesome. Awesome. Did you say where that was? I may have missed
It
it.
yeah, it's I didn't say, but it's a suburb of Dallas, Texas. So it's in the Dallas MSA, so the southwest corner of Dallas.
All right, sounds good. Now, the other properties you own, are those also in Dallas?
No, so this will be our first deal in Dallas. We own three in Houston, and then one in Kansas City, one in Greensboro, North Carolina.
Okay, nice, nice. What's your philosophy around that? I mean, you have a couple different cities that you mentioned. I've heard arguments both directions, What's your philosophy around, where you're buying stuff?
Yeah, so every 6 months, the team sits down and we basically do a market study just to determine what markets we want to be pursuing. We look at things like population growth and employment growth. We look at things like supply coming online, demand growth. We want to see that the cities are tend to be landlord friendly as opposed to tenant friendly. So in many ways, we try and track the political leanings of areas and how those are transitioning because that plays a lot into whether a city is going to be landlord or tenant friendly. We like to look at past performance.
Yeah.
So we don't do it as much because we're now about 17 years past the Great Recession. But for many years, we were basically looking at what happened during the last recession. And because what happened during the last recession might give us some indication of what's going to happen during the next recession, because in a lot of cases, the makeup of a city hasn't changed much. Maybe the employment characteristics or the employment diversity or the population diversity hasn't changed much. So if we saw like a big downturn in 2008, there might be reason to believe that if we were to head into another recession over the next couple of years, we might see a big downturn in that market again. And so we tend to look for markets that were pretty resilient in 2008 because that tells us that they probably have a good bit of employment diversity and leads us to believe that they might be resilient should we see another downturn. So we look at things like that. And then about every 6 months, we kind of make our list of here are the top 5 or 10 markets that we would consider. And then the partners kind of vote on what markets do we want to be pursuing. And
Yeah.
in many cases, it's the same markets we've pursued the last 6 months and the 6 months before that and the 6 months before that. But occasionally we will make a shift. We'll move out of a market or move into a new market.
Yeah, different philosophies. And I mean, if you look at the properties in my portfolio, I think I own properties in 8 or 9 different states right now. But the things that I'm chasing now are all in one market. When we were buying stuff in other cities, other states, we were looking at it from that end. Hey, we have confidence in this city, this market. We have confidence in all of this. I think there's definitely trade-offs going both directions. So
Oh yeah, and for anybody starting out, I highly recommend pick one market. Especially starting out, there's a lot of benefits to one market. One, you get economies of scale. So
mhm.
if you're buying 5 properties in the same city, well, you can now buy 5 times as much in terms of materials. You can find the same labor and reuse the same labor, and so you get economies of scale there. Two,
Yeah,
property management is probably the hardest and most important thing in this business. And if you can find a great property management company, scale with them because
yes.
it's hard to find a great property management company. And having to find 5 different property management companies in 5 different states can be very challenging. So that's another great reason. Another great reason is simply because deals are hard to find. You rely on the relationships you're making with brokers. And so building relationships with brokers can take months, even years. And we're still building relationships with brokers that we first met back in 2018, 19, 20, and they're finally starting to bring us some great deals. And so if you're trying to build those relationships with brokers in 5 different markets, it's going to be a lot more challenging than in one market. So for anybody starting out, and even as you scale, I mean, we focus a lot in Houston. We've gone to Dallas, which is just about an hour and a half up the road. So it's not that far away. I mean, for anybody starting out, I highly recommend pick a market and focus on that market until you've
Yeah.
broken it.
I'm just going to take that a little further. Once you have a little bit of experience in one market, it's so much easier to break into a second. I've done a lot in South Carolina. I think 9 or 10 properties in South Carolina, all syndicated. And, then when we started looking at different markets, it was a lot easier. that first call with a broker, brokers are going to size you up every time you have a first call. But that first call with a broker, if you come in saying, hey, I'm a multifamily operator, I own this much and I've done this much, and I'm looking to expand in your metro, I mean, that's a
Huge.
day difference. So,
Yeah.
but there's certain things that appeal to me about being flexible and going to where the market takes you. But, I think for me, I've done both sides and I've chosen, I think it's definitely a choice. For me, I've chosen now to focus after being all across the board and pros and cons both directions. I think the management's the hardest when you're spread out, but
Management is hard. The downside of picking one market is what happens if that market changes. What happens if a large employer leaves, if there's a downturn in that market's economy, if there are some major natural disasters. What you can find is that now that that one market that you were in, you're thinking, I probably shouldn't be in this market, but since it's the only market I know, I'm going to stay here for the wrong reasons. And so that's the big risk. But I think the benefits of staying in one market probably outweigh the risks.
I like how you guys are doing it. You said every 6 months or so, you guys sit down and reevaluate. You have your criteria, you guys know what you're looking for, and you make some very conscious decisions about where to go, knowing that breaking into a new market might be a little difficult.
Oh, yeah. And don't get me wrong, we're not changing direction every 6 months. We're basically looking at all of the markets. And most times, what we decide is where we are is where we want to stay. That's the outcome of most of those 6 month discussions. But every once in a while, it's, hey, maybe we should be moving away from this market for this reason. Maybe we should be moving towards another market in addition. But most of the time, it's, hey, status quo, keep moving forward where we were.
Yeah, I focus on Salt Lake City. I get asked a lot, well, what about this metro? What about that metro? What about, and my answer right now is the same. Is like maybe later, but not now. I think for me personally, I want to have a certain size footprint and a certain members of the team built out and certain things in place before I move to another metro. Right now, we're very lean, but to break into another metro, it's also personnel intensive. So we're going to need
Absolutely.
certain people that are boots on the ground and everything else. So
Yeah.
anyway, looking at the clock, we've been talking for just over 30, so we got a little bit of time left, but let's talk about current market challenges and then what you're expecting to see in the future.
Yeah, so I think the biggest challenges is just uncertainty. There's a lot going on politically, economically. We've been in about an 18-year bull market. Well, it's been 18 years since the last downturn, and we've probably been in a 12-year bull market, which is pretty unheard of and unsustainable. So at some point, we're going to see market softening, regardless of political environment. Everybody thinks it's a political thing, but I was saying this before the election last year. Regardless of who gets elected, they're going to be in a tough spot because after 12 years of the economy basically going in one direction, we have market cycles. Things slow down, and I think we're in for that in the next couple of years. The nice thing is that not all asset classes move in the same cycle. And what
Mhm.
we've seen is that multifamily has, for the most part, been in a recession for the last 3 years. So starting in March of 22, when interest rates started to go up, multifamily values crashed. We
Mhm.
saw 20 to 25% drop in multifamily
Yep.
market values in about 6 months after March of 22 when interest rates started to go up. And we've kind of been at that low plateau for the past 3 years. And it feels like we're starting to move out of that. And I suspect we'll continue to move out of that. If we see a broader economic recession, I think that could slow down the recovery in multifamily. But I do think multifamily is kind of running countercyclical to the broader economy right now. And things should be good in the next couple years. Where we need to be concerned, if inflation is coming back, and we don't know if it is, but there's always the risk of inflation coming back. A couple of my good friends have been saying it for years that the inflation we saw a couple years ago, it's not going away long term. And so we run the risk of material costs going up, labor challenges. There's some, obviously, with immigration, we run the risk of some labor challenges and labor costs going up, supply chain issues just with tariffs and trade. So there are definitely some potential headwinds, but I think at the same time, multifamily, again, we've been in a recession for 3 years. We're starting to see some recovery. We're starting to see rents go up again. I mean, we've seen either negative rent growth or flat rent growth in a lot of the markets that we're in for the last couple of years. We're finally starting to see that trending up. Supply again has probably peaked, and so we're going to start to see a reversal in the amount of supply over the next couple of years, which will lead to higher values. Hopefully, interest rates will come down over the next 6 to 12 months, which could help cap rates compress a little bit. So I think ultimately, I'm not convinced that the broader economy is in a great place right now, but I do think that multifamily is heading in the right direction.
Yeah, and I think one thing that I always look at is people always need a place to live, and I think when I compare it to other commercial real estate sectors, different technologies or different companies have disrupted retail and office. And I mean, there've been a lot of disruptions in other areas that have, in a very short amount of time, caused not necessarily a
Yep.
collapse, but a huge downturn. And yes, multifamily is susceptible to downturns, but when you really look at it, people have to live somewhere, and that's what I keep coming back to. I think, we are in a relatively high interest rate environment for now. I think, we're going to see some easing. We're going to see cap rates come down along with it. By the way, the inflation report came out today, if you haven't seen it. So we're at 2.7, which we had a couple straight months of that number going down, and we ticked back up. So yeah, I'm bullish for lots of reasons. I think most of the things that you said we're going to see. It may take a little longer than I anticipated. But when you look at long term and take a step back and look at 30 or 100-year history,
Yep.
real estate always bounces back,
It
and
does.
multifamily tends to bounce back the quickest. So
And the other thing is with multifamily, unlike single family where you're buying today and you're going to be considering selling in 6 or 12 months if you're flipping, or a couple years if you're holding as a rental, perhaps, with multifamily, typically the shortest hold period you're going to have is 24 to 36 months. And in many cases, it's going to be closer to 5 years or 7 years or 10 years. So the question to ask yourself when you're going into multifamily or looking at a multifamily acquisition isn't where is the market today? Where is it going to be in 6 months? It's where's it going to be in 3 years or 5 years or 7 years? And like you said, you look at any 5 or 10 year period and real estate only goes in one direction.
one thing that we try to do, which we did in upfront, the first couple of syndications, it's like you're talking about your flips, sometimes, stupidity is what makes the decision for you. But, we're trying to make our exits flexible,
Yep.
so even our value adds where we're only expecting to hold 2 to 3 years,
Yep.
we always paint the picture. What does this look like holding to 5? What does this look like holding to 10?
Absolutely.
Can we pivot? Can we flex? Looking at hundreds and even thousands of years of history, property values keep on going up and up and up. But when you dial in on any 2 or 3 year stretch, that's not a guarantee. So,
Absolutely.
yeah,
And your investors like hearing that. They want to know what's the plan B if plan A doesn't work? What's the plan C
yeah,
if plan B doesn't work? Because it gives them the confidence, not only are there a plan B and plan C, but you've actually thought about it.
yeah, exactly. Exactly. So, well, awesome. Well, we're time to wrap up a little bit. Got 3 questions that I always ask everybody, and I've already asked one of them. It's what's next? What do you see coming up? And we already talked about that. So the next to last question is, if you had to give advice to somebody who is just getting into the multifamily space, what would that advice be?
Yeah, it's really tough to find deals right now, but they're out there. And what I like to say is I meet two types of people in this business all the time. Most of the people I meet have never done a deal. They've done zero deals. 95, 96, 98% of people I meet have never done a deal.
Yeah.
The other type of people that I meet are people that have done 5 deals, 10 deals, 50 deals, 100 deals. There's one type of person I never meet in this business,
Mhm.
and that's somebody who's done one deal. Nobody in this business does one deal, because if you do one deal, you're
Mhm.
going to be that person that gets to 5 or 10 or 50 or 100 deals. So what I like to tell people is if you're at that zero and you think going 0 to 1 is like near impossible, it's tough. Don't get me wrong, it's tough. But if you can get to 1, it gets so much easier. Nobody stops at 1. Once you get 1, that second comes a lot easier. The third comes even easier. The fifth and 10th and 50th come even easier than that. So just
Mhm.
don't stop till you get to that first deal, and you're going to find that you're easily getting to 5 or 10 or 20 after that.
Yeah, I mean, I've heard a lot of people you talk about the law of the first deal there, but once you get to one, if you've gone through the work it takes to get to one,
Yep.
you might as well do two, because
Yeah,
yeah, you might as well. All that work and effort, we're seeing, sometimes 12 to 18 months for people to get their first deal after committing. So once you got your first, you might as well do your second.
exactly. So
So
much easier.
yeah. Awesome. Well, hey, Jay, appreciate your time. One final question as we close up. How can listeners learn more about you?
Yeah. So jscott.com, letter J, SCOTT.com. And that will link out to, there's my email in there if you want to get in touch with me. And then anything else you might want to find out about me, our business, or what we have going on, would love to stay in touch.
Awesome. So we'll have that in the show notes. Anybody wanting to reach out to Jay, jscott.com is the place to do it. So, Jay, once again, appreciate you for coming on the show today.
Thanks, Brian. Appreciate you having me.